So the authorities are looking at one more tool to shore up confidence, to bring money in to critical sectors. But who are the takers?
Well, if you look at what the Chinese government said in December last year from the Central Economic Conference. So the government is focusing on more long-term policy, pushing the development of some long-term industry, technological development, etc. So hopefully this could be a long-term growth driver for the Chinese economy. And on the short term for this year, the Chinese government also try to have more infrastructure, which hopefully to mitigate the negative effect of less property investments. And for property side, you can see that the Chinese government, they do give some support. I think this is to avoid exacerbations from the current situations to be too bad. But you can see that the government is trying to have growth driver from other aspects and then to mitigate the downside from the property sector. This is what the Chinese government aim at.
And maybe Ping An's going to be giving a little bit of support, but this is the question that I have to ask you, Pierre, because I like looking at reaction functions, right? And if we look at the United States over the course of November and December, you have a little bit of a loosening of liquidity, more gets injected into the system, and you see that being reflected into asset prices. What we've had over the course of, say, the last 6 months or so in China has been an abject amount of liquidity being pumped in. We've got even more coming through just throughout the course of this week, and you're not seeing the reaction function. What that would indicate is that is doing just enough to have these sets of circumstances take place where you continue to see selling pressure coming through. So barring any kind of massive stimulus coming in to provide that liquidity function, what's going to drive these Chinese equity markets higher?
Well, firstly, I think in terms of monetary and fiscal measure, we do expect that Chinese government to reduce policy rate by 20 basis points and triple out by 50 basis points this year. So we do expect them to do something. But based on our due diligence with the government, we don't think that there will be a massive round of, say, liquidity easing because they don't want to have another round of overcapacity. So we have to be realistic. I mean, we can't expect too much. They will try to do something, but should not be excessive.
So what does that mean for equity markets? Because, like I suggested, we're seeing all of this support coming through, and yet we're still seeing the equity markets in the doldrums. That would indicate that liquidity is getting soaked up and being rediverted elsewhere. So should we expect any kind of turnaround in, Chinese equities if it appears to be that on the domestic side no one believes in them either?
Well, overall, what we are expecting is that Chinese economic outlook this year to be mediocre. So there will be some challenge there. And so we are quite selective in terms of our positioning for Chinese equity for 2024. We understand the economy is pretty tough. Property sector would contribute a drag. So we like some aspect like the technology side with the Chinese government have more long-term support. And in terms of, say, some short-term cyclical earning recovery, we still like some sector like gaming, traveling, tourism, etc. And we definitely like the high-yield play, like oil name, telco. We think that they are defensive. So there are some areas that we like, but we have to admit that challenge also exists in the Chinese market at the moment.